Now, this particular video will include three components and three elements that I will put all into one informative video that will fall under the heading of management. Okay, and it's going to include several of my thoughts about technical analysis, monitoring some key support and resistance levels as you're entering and managing trades, as well as how to use resources to set up contingent orders, and then lastly, some considerations for gap risk, hedge protections, black swan type events. So I imagine this video is probably going to be, mid-range, 30 to 40 minutes in length. I will do my best to keep it as brief yet as thorough as possible. So I don't want to ramble, and I don't want to try and recreate a lot of information that is already going to be shared and discussed in the videos below, with all the examples of all the different guidelines you'll now have access to. But I do want to at least have a place to where you can visit and watch my thoughts and hear my opinions about these various different things. And so when I say trade management, that is once the trade is open. Okay, so right off the bat, when a trade is executed, we talk a lot about having that trade plan, creating that trade plan, predetermined trade plan, know where your adjustments at in your trade plan. And so once the trade is active, you should already have a pretty good idea where you're going to be managing that trade in terms of adjustments. Okay, and that's based upon if you're trading a condor, a butterfly, all the many different variations. And so in advance, that trade management is going to be referring to trades that are already open and active and alive. Okay, and so we're not on the hunt searching for trades right now. And I think a lot of times when traders talk about charting and technical analysis and monitoring support and resistance levels, the idea that comes to mind is, well, we're on the lookout for trades. And so that's not the case here. And what I'm going to do is I'm going to show you the S&P 500. That's the one that we talk a lot about. And this is the current monthly chart here on the S&P 500. I don't like looking at the candles when I'm drawing just real basic horizontal support and resistance levels. And again, as you hear me talk a lot, I don't trade the technicals. I want to be aware of the technicals, but I'm definitely not trading around them. I'm just not good enough at it. All right, and that's the honest truth. If I were better, maybe I would have a little bit more confidence and put a little bit more trade activity in that category. But I am perfectly content accepting my limitations with technical analysis. I do understand the concepts and the core fundamentals of horizontal support and resistance, and that's why I want to share those here, because there are some very skilled traders that are able to pick up the charting opportunities. And there are, I mean, it's a craft like any other. If you're willing to invest the time, I know many traders who swear by technicals. For me personally, I'm about 50-50 on them. So I choose to spend my time elsewhere, leaning into strengths I have in other places. So if we want to start, first and foremost, if we're talking about key support and resistance levels, I think that the two major, or I could even say the three major technicals to think about, first and foremost, is horizontal support and resistance. Then next would be your trend line that you draw, support and resistance. And then lastly would be the moving averages, and that's what a lot of people swear by. A lot of big institutions are only monitoring that 200-day simple moving average. So I think it's important to at least be aware of them and learn how you can potentially and possibly use them in your ongoing trade management. Because let's face it, if we have a trade plan and we have a unbalanced or a broken wing butterfly or a condor that is very safe and there's no danger of any problem until we got, say, in this area right here, and the market is trading way up here, well, we can obviously see we don't care so much about that. We don't care so much about that. We really don't begin worrying about a trade until we got into this range down here, if we were monitoring some of these key support levels or resistance levels. And so starting out at the beginning with a monthly chart here, let's just do this, make it a little bit cleaner. The very first thing I want to do is say, all right, well, this is an obvious level of support. This right here is an obvious level of horizontal support. Actually, let me back up. If I want to go and say all the way back down to here, I can draw a big box and I can say that level right there. We've got an obvious change in sentiment back here in late 2002 when the market was selling off. Again, these are monthly candles. So this is all of the trading activity in a 1 month time frame. When the market got down to this level right here on this candle right there, that one, it changed its sentiment and the bias switched from trading down, right? Down, retrace, down, retrace, down, retrace. It traded down, but it didn't get lower than that absolute low right there. So when that happens, that confirms that that is an obvious swing point, because then look at what happened. It traded lower. Let me get rid of all those. What happened was the market traded lower. It was trending down. This candle right here, and I wish I could zoom in a little bit more. I can't, but it'll be a little clearer on the weekly. That candle right there, that was the absolute low. And then when it traded higher, when it came back down and revisited, it did not break and penetrate that absolute low of that candle. So that's a pretty important area to identify and draw on a chart. So we would draw that as a horizontal support level. And that becomes support until it gets violated and retested. And you'll see it did not get retested for 1, 2, 3, 4, 5, 6 years. It did not get revisited. And so when it gets revisited, we have to be prepared for a reaction of some sort. And that reaction will either be violated and just, completely disrespected and just, continues on blowing through, or it holds and you get a change in sentiment. So you can see that this candle right here is an obvious change in sentiment, because that's a swing point high. The market was going higher, it retraced, it went higher, it retraced, it went higher. When it retraced, when it came back up and hit that, look at the pretty significant sell-off from that level. And I think that's very, very important to take note of, because when you start monitoring horizontal support and resistance levels like this, all right? So we've got this as a horizontal support level. Well, the horizontal level was violated, but now this is the new absolute low swing point that happened, 7 years ago? 1, 2, 3, 4, 5, 6, 7.5 years ago, a little over 7 years ago. So you'll see that now, are we going to possibly get back down to there? I have no idea. But when we do, if we do get back down to this level, expect a pretty significant reaction, because that is the most obvious swing point, because that was a change in sentiment. The market was dropping down. It stopped on this candle here. It retraced, it stopped again, and then it just took off. There was all kinds of buying pressure. There was no retracement whatsoever, like we saw back here. But then when it did retrace, it resumed its upward thrust. It retraced, upward thrust, retrace, and you can see this pattern plays out over and over and over until it reaches that stopping point, and then it gets violated. And so when we draw these horizontal support and resistance levels on the chart, so we got this down here, we've got this one down here, we have a very obvious level at 1800 that we're looking at. And again, this applies to all charts. Pure, if we're talking pure and simple technical analysis, doesn't matter if this is the S&P 500, if this is Facebook, if this is Apple, doesn't matter what the underlying vehicle is. The horizontal support and resistance principles are the same across all vehicles. So the support that you have on the bottom side is the exact same as the resistance that you have on the top side. And you'll see that that was resistance that when it broke through in mid-2016, when it retraced, it took back off to the upside. And so now that is a very clear area of resistance that has now become support. And again, you know, there are many books about technical analysis. I'm not going to try and spend a lot of time, you know, diving deep into that, but horizontal support and resistance are some of the beginning stages that you really have to look at. And then, you know, if we zoom out here, let's do this. Let's go back to a monthly. Let's zoom out. All right. And if I just go right here and I want to draw this level here, and I want to draw this level here. And actually, you know what? I need to do one thing. I need to draw it with this. That's right. All right, so if I draw a horizontal line here on the monthly, and then I come up here and I draw a horizontal line here. Now when I switch over to the weekly, all right, you'll see that it is there. All I did was, let's zoom in a little bit here, is I matched all these upper swing point highs and I drew a line across the top of them, so that you can see when we zoom into a weekly level, these are weekly candles. We've got all this resistance. The market cannot break through. When that happens, you begin to draw lines on your chart to monitor that, so that you'll see it sold off, all right? And then what happened? Well, it came back up again. It couldn't break through. It kept trying. What happened when it finally did break through? Well, then that level becomes support. And is it crystal clear right to the penny? No, you can see it violated that a little bit, but when it broke through and it stayed above for, you know, we can count all those, but it's, you know, greater than 10 weeks, when it stayed above that obvious level of resistance, well, that becomes a very strong level of support. And you can see, even though 1 week dipped below, you had many weeks that stayed above, and what happened? The bulls just took it right back over. If we zoomed in even, you know, farther onto a daily level, then what we can see is, right? I mean, from a daytime frame, we don't need to trade the 20 tick or the 30-second or the 5-minute charts. The daily charts provide us enough ammunition to trade with, and you can see now you had many days where that was a obvious level of resistance. And what did I show before? Well, when that happened, what did it do? It rejected it. Well, when it came back up, it could not quite hit that highest level, and it got rejected. It came back up again. It could not break that highest level that was already hit back here, and it got rejected. And each subsequent time is going to bring less and less potential with it until you have big sell-offs. Well, now what happened after it did finally break through? And let me zoom in just a little bit more here. All right. So what finally happens? You get the testing, sell off. The market absolutely has a memory. So what happens when it comes back up and it tests that level? It's coming. It's coming. I guess I didn't extend it far enough here. Let's do this. Oh, it sure did. I don't know why I did not. Well, maybe because it's too long. But you can see that the level right here is just shy of 2100. It's what, about 2140. So you can see when it finally does come through, when it breaks through, it stays above. This was that one little week that we saw that dipped below, and then it just took right back off. And so the clear takeaway is these levels of support and resistance, the horizontal levels. That's, why is this not coming off? Well, we'll just leave it on there for now. The horizontal support and resistance levels that we see on these charts, that we see over and over and over again, all we have to do is we can say, well, we can draw these horizontal levels. This is an obvious swing point right here. We can say that this level down here is an obvious swing point. This level down here is an obvious swing point. This level down here is an obvious swing point. So we take note of them so that we know at the 2100 level, if we have a trade that's active and alive that doesn't require any necessary adjustment until, say, 2000 or 1950 or lower, when we hit to this level, there's nothing to do but just monitor and watch how the market behaves. And so when I say that we want to monitor the key support and resistance levels, that's what I'm referring to. We're not making trade decisions, but we also are trying to be mindful that I'm not probably going to create and construct a brand new trade that's going to align with a key support and resistance level where I may have to adjust it. So I would be less likely to put short strikes at this level because I know that that's typically where I don't like to let trades get violated. It's at the short strikes. So again, there's all kinds of different ways to use your knowledge of technical analysis and these trend lines on charts. But the bottom line is we have to manage our trades, and we manage them by the predetermined trade plan and the guidelines that are set forth. Okay? So that's the horizontal support and resistance levels. And we are obviously going over 30 minutes. I am so sorry. But again, I want to be thorough. I really do. So that's horizontal levels. I'll just talk real quick about, obviously, then the trend lines that we draw are based upon, what we can clearly see based upon the market that's giving us. This would be the way I would draw this trend line here, because you've got an upward sloping market that keeps retracing, but this is the absolute lowest point on the chart right here for an upward sloping trend line. And you can get into all kinds of wedges and flags and pennants and bulls and bears, and there's many different charting patterns. Martin Pring has a great book, Pring Price Patterns or something like that, if you want to investigate it deeper. But horizontal support and resistance is by far and away the number one. Then you've got your trend lines that you draw by hand. And then last, we'll put the moving averages on there. This is a 52-week moving average. And all that means is that this takes the prior 52 weeks of trading. So it takes the prior 52 candles and it averages them, and it plots a line, the average of all of these prior 52 candles. If we look at that on a daily time frame, well, you can see that's a 52 moving average on the day chart. A 52 moving average for the prior 52 days is a lot different. All right, so let me show you this, and I'll illustrate this. Easiest way that I know of how to do this is we'll say, let's do this. All right, so we'll go, instead of a moving average of 52, let's do 200. All right, so now this is a 200 moving average. You can see that down here it has this plot at 2169.08. All right, so that's the moving average at 200-day moving average, 2169. Look at where this market stopped right there. All right, and that's why a lot of the institutional traders will, that's all they watch, because you can see if the market's trading above, they're bullish. If the market's trading below, they're bearish. And that's what a lot of big hedge funds, large traders, that's all they watch. So sometimes that can be considered a self-fulfilling prophecy, right? But if we switch to the week, well, now that becomes a 200-week moving average, and that is clearly much different than the day, because remember, our day was 2169, and now this right here is 1981. Then, of course, 200 month, probably not even 200 candles here, so it's bad example, but I think you can get the point where if I change that then to 50 or 52, the 52 weekly moving average. All right, settings, 52. The 52, the reason why I look at the 52 is because there are 52 trading weeks in a year. So this aligns pretty straightforward with, there are 252 trading days in a year. All right, so if we look at the 200-day moving average and compare that to the 52-week moving average, they're pretty darn similar. They're pretty darn close. And again, the only reason why I add the discussion in here is because when we add that in with our horizontal support resistance, our trend line drawings with the moving averages, that gives you the quick, clear indication. Obviously, this is a bullish market. We are in a bullish environment right now because this is sloping upward. We're a long way away from clear levels of turning points in the market, clear swing points. And until this gets violated or retraces, then odds are going to be in the bull's favor. So you have to be aware of that, all right? And that is part of the conversation on trade management once trades are live. Contingent orders, I'm not going to spend a lot of time talking about that because there are a plethora of video lessons in there that will do a much better job than I can. Contingent orders are something that if you are working full time, or if you don't have the ability to be at your computer during market hours, and I know there are several traders that I'm working with that are overseas, and if your time schedule is different than what the market is open, or if you're just not able to access a computer, you're really going to have to learn how to rely on these contingent orders. And so the contingent orders are just a way to say when certain conditions are met, then the platform will execute orders. I am pretty sure you can do the same thing with Interactive Brokers. I am not familiar with them. I use all of my trading on Thinkorswim, so that's why I want to share this with you. But I would just investigate a little bit I'll investigate some on Interactive Brokers and see if I can post a link as well. Okay, well, they do, absolutely. And this will be the link where you can look at as well. There's all kinds of conditions and limits that you can place on your option trades. Thinkorswim, if you go right here to the Learn Now button, all right, this right here, the Think Manual, you can go into the Think Script. This will give you some different strategies and different coding abilities to, code on charts and code strategies and whatnot. Obviously the mobile trading how-tos, but right here, the Think Manual, this is where you're going to find all of these video lessons. And so right here, if you open up the Trade button right here, Order Entry Tools is going to give you all of the ones, how you're going to create custom conditional orders. And it's a very straightforward video lesson. It's about 6 minutes long, and that will definitely get you started in the right direction. Just understand that when we start looking at some of these lessons or some of these guidelines, right, in the titanium module that you now have access to, then what we're going to be looking at is all of these. Let's just open up this one right here. Let's just say this one right here, Condor Core. All right, so now if we open up this one right here and we say, all right, I'm going to need to learn how to put in conditional orders, because if I get one of my short strikes violated, well, then I can say, all right, well, if this gets violated, then execute this order. And that is very simple to do. I'm sure Interactive Brokers is the exact same way. So that is something that is really beneficial if you cannot be at your computer during the market hours. So we'll make sure that we'll get you up to speed on that. Lastly is the gap risk and hedge protections. This is just a simple way to start approaching how you're going to protect portfolios or accounts that have a lot of overlapping trades in them. And if we have 4 or 5 overlapping trades and overlapping expiration cycles, and we need to look at the Thinkorswim platform and aggregate all of our positions and beta weight it. I've got videos on that in the upper section, how to do that. Then we need to know, all right, well, what is a 5 or 10% move down going to do to all of our positions and aggregate? And this is just a very quick way when I say, when we want to do ratio spreads out of the money, or we want to do debit spreads at the money, or we want to purchase out of the money puts, the way that you set those up. And again, this is just a starting point. It's we're not using this as a way to make profit. This is just for hedging against catastrophic losses. For the smaller accounts, I do not trade with these hedges. There are many barriers before I would get into a situation that I would be concerned on losing an entire account. All right. Now, if the account is 6, 7, or 8 figures, of course, 100%, then you are going to need to understand and accept that this is necessary so that you can sleep at night, unless losing that much amount doesn't bother you. It would bother me tremendously. So that's why I think it's important to put that in here. Very simple, right? You can come to any of these layered options, and I know traders that do it on a rolling weekly basis. They go out about 10 to 15 days to expiration, and all they do is they just go out here and let me change this, and you can say, all right, I'm going to go right here. We'll say 10 days from now in expiration, I'm going to come right out here, and I'm going to buy. If I buy an option that's going to cost me about $1.60, all right, if I buy one, it's going to cost me $160. All right, this is going to be a 100% maximum loss. I am not trying to make money on that. But if we get, for example, let's just say a 10% correction down, and the market opens up 10% down here, right? 10% move, and we find ourselves down at 2111. Well, that $160 has just returned you $17,670. All right. So again, it's very unlikely that the market does that, but if it does do that, and you are trading a $200,000 or $300,000 or $400,000 account, and a 10% move down wipes out 30% of your account, well, you absolutely better be considering spending a little bit of insurance money on a regular interval basis to protect that. And then of course, obviously, if you are protecting, a much larger account, well, then you just change the number of contracts to create, the same kind of profile. That is one simple way to do that. Out of the money puts is one way to do that. Another way is just to come right at the money and you buy a debit spread. It's the same thing. It's a net debit out of your account, but what that does is that says, all right, I've capped my maximum profitability, if you will, for a predefined amount of insurance. This is less than ideal for the black swan type protections. This is more for if you're, say, preserving profits, or you're protecting profits and you want to turn your trade into a risk-free trade that I've talked about a couple videos above, and that's a more appropriate adjustment. But it is a maneuver that's available for protecting against these gap risks and these surprise big down moves. All right, and then the last variation, if you want to do for some of these hedges, if you want to do these ratio spreads, and all that means is you're going to come out and say that I want to sell this one right here. All right, I'm going to generate a $347 credit into my account. Well, then I go farther out, and maybe I go ahead and buy 3 of these. All right, it's an unbalanced type of spread, meaning I sold this for $350, I buy this for $300, so it's a net debit out of my account. But what does that do is that gives you that same kind of unlimited potential, if you will, to the downside. Same thing, right? If we look at this, it's a net credit into our account, but if the market corrects 10% down, well, now instead of making the 17,000 like we did on the first example, now we're going to make 23,000 on this example. But at the expense of you expose yourself to this little narrow window right in here, right? It's maybe not so narrow, maybe 50 or 60 points in width of a little bit of danger. Now, if that doesn't bother you, or you need to adjust and say, well, maybe if I sell 2 and buy 5 or something along those lines. See, that would actually make it a little bit worse. Maybe we would say, maybe I sell 3 and buy 5. All right, we're still benefiting from this big move to the downside. That's 2, maybe we'll do 6. You have to, you can experiment with all the different variations, but the idea is to keep this T+0 line as much above this 0 line as possible, so that we don't find ourselves in this little valley of death. If 10 days from now it dropped right in here, well, it's going to be the hedge is going to be useless. And you do that by rolling these weeks around. It's a little bit more active, requirement, but it protects your overall portfolio against, massive black swans or these, 10, 20, 30% gap open moves down. Is that a possibility? Of course, it's always a possibility in the markets when you're trading. Is it highly likely? No, it's not. But if you're trading a retirement account, or if you're trading an account that's taken you many years to accumulate, why take the chance and why risk? My philosophy is always mitigate risk first and foremost, and then worry about profits second. So why take the risk on having a catastrophic loss that can, wipe out 30, 40, 50% or more of your account when it's not necessary, all right? But like I said a few minutes ago, for the smaller accounts, and I define a small account as under 50,000, for the smaller accounts, the reality is you can lean into your profitable trades a little bit more and save the money on the hedges so that you get that account a little bit larger, a little bit more efficiently, if that makes sense. And some people aren't comfortable with that, and if that's you, and if you want to be putting the hedges on from the get-go, by all means, this is okay. But just understand that there will be that trade-off, and there is the cost associated with it. Anytime you put on a hedge, you're going to be taking away from the overall profits from your trading. All right, so I think I'll close it on that. I don't want to make these super long, but I do want to make them informative and thorough enough so that you can get the main concept of what I'm trying to get across here. And so for this particular one, the management really is going to consist of just mastering the contingent orders, accepting if you're going to be a hedge player or not, if you're going to start that from the beginning, or if you're just going to wait until your account gets a little bit larger, and then becoming either remotely or very intimately familiar with technical analysis. And I think those three are really relevant when you start trading some of these multi-legged and very profitable strategies. Okay, so thanks much for listening and for your patience. And if this elicits or sparks any questions, please don't hesitate to send them off. I want to make these videos as valuable as possible, and if they need to be edited, please just send off any feedback that you feel is beneficial for future listeners. All right, thanks much, guys. Bye.